I'm Ben Bernanke, Chairman of the Fed. And yes, this is 86% dark chocolate.
Hello, I'm Woodrow Wilson, the 20th President of the United States and the creator of the Federal Reserve. And yes, this is Starbucks coffee.
And I'm a member of Def Leppard, the greatest band that ever existed, and I'm here to learn about economics. USA!
I, Woodrow Wilson, am responsible for creating the team of advisors that crafted the proposal which ultimately became the Federal Reserve Act. This act was passed by Congress in 1913. The legislation called for the creation of a network of 12 regional reserve banks, headed by a 7-member Federal Reserve Board made up of public officials appointed by the President. The Federal Reserve Act was initially unsuccessful because in October of 1929, the market experienced a drastic crash. Almost 10,000 banks failed in the following 3 years, leading to Congress to pass the Banking Act of 1933 to reform the banking system. This act was known as the Glass-Steagall Act, which functions to separate commercial and investment banking. It required the use of government securities as collateral for Federal Reserve notes and established the Federal Deposit Insurance Corporation, or the FDIC.
The Federal Reserve functions as a central bank of the United States, which means that it has the power to regulate the money supply as well as the activity of commercial banks. It is also known as the banker's bank or the lender of last resort, because it is where other banks take their loans out from.
The Fed is able to monitor the activity of other banks through 3 important functions: the reserve requirement, the discount rate, and open market operation. The reserve requirement is the requirement set by the Fed, which establishes the minimum amount of money that banks must keep as a required reserve. This is useful for ensuring the health of the banking system because it prevents bank runs from occurring. The discount rate is the rate at which banks can borrow money from the Federal Reserve. As a lender of last resort, the Fed is responsible for lending out loans to banks in need. The discount rate establishes the interest rate of this loan.
Open market operation involves the purchase or sale of government debt by the federal government in the form of U.S. Treasury bonds. This is the primary tool of the Fed to regulate the money supply. The Fed uses these 3 tools, open market operation, reserve requirement, and the discount rate, not only to monitor commercial bank activity, but also to regulate the money supply. For example, a lower reserve requirement increases the money supply because more loans would be able to be given out and there'd be more money to be spent. The lower discount rate would increase the money supply because banks would be more likely to borrow money, then more loans would subsequently be given out, and more money would therefore be in circulation. The money supply could also be increased if the Fed buys bonds from banks. By buying bonds, they are giving more money to commercial banks, giving more money to potentially loan out, and more money to potentially be in circulation.
So I kind of get it so far. But how does the Reserve control money supply and enforce monetary policy?
Monetary policy is the process by which the Federal Reserve controls the money supply. Policies are set in place in order to influence economic issues within the nation. These issues include economic growth, unemployment, and high inflation. Typically, the Federal Reserve alters the money supply by one of 2 policies: an expansionary policy or a contractionary policy.
An expansionary policy increases the aggregate demand. The Fed creates this increase by lowering the discount rate, lowering the required reserve, or by purchasing of bonds. Doing so increases the money supply, and as a result, people are more willing to spend. The result is lower unemployment, but at the expense of high inflation and high interest rates. Now, a contractionary monetary policy, on the other hand, decreases aggregate demand. The Fed creates this decrease by increasing the discount rate, increasing the required reserve, or by selling bonds. This decreases the money supply, and leaves less money in the pockets of consumers. The result is low inflation and a low price level, but at the expense of a high unemployment.
While the ultimate goal of monetary policy is to achieve a stable economy, this is often difficult. The effects of monetary policy exist only in the short run, and often one policy is used to correct the negative effects of the other. Monetary neutrality is a concept that states that money supply does not have any real effect on the economy. For example, say the Federal Reserve wants to increase aggregate demand. They increase the money supply, thus lowering interest rates. As a result, the aggregate demand shifts out, thus creating an inflationary gap.
But what will happen in the long run?
Well, in the long run, an inflationary gap will cause aggregate supply to decrease, price level to increase, and GDP to decrease. The economy will continue to shift back to produce a potential output, but price level will increase. Ben,
What?
this is important. Pay attention.
What? I was taking a selfie to send to Barack. What could be more important than that?
All right. I think I understand now, and I'm going to try and bring in a modern day example to try and make this make sense. Okay. So in your recent testimony before Congress, you said that the Fed would continue to buy $85 billion in bonds each month until it felt confident the unemployment rate would fall to 6.5%. So in the coming months, the amount the Fed would buy might increase or decrease depending on economic statistics. At the moment, there's no reason to change though, right?
Right.
When the recession started in 2008, the Fed started buying bonds to put more money in circulation due to the recessionary gap that resulted. This focused on creating low interest rates so people would invest more. However, there's a certain point at which the purchase of bonds has to stop so that the interest rate doesn't become too low. So today, you're saying that they will buy bonds to drive interest rates down if it's necessary. If not, then they will stop driving them down. So first you said that you wouldn't stop the bond buying program prematurely, but then you said you might cut back on the program in the next few meetings. So you're kind of confusing me there, but the bottom line is you're going to wait till you see the data.
That is correct.
Nice.
That's all for today. We hope you enjoyed this special edition of Economics USA with myself, Ben Bernanke,
Woodrow Wilson.
Unnamed member of Def Leppard.
Economics USA.
S.
Hey!